Okay, what's going on, everyone? Hope we're having a good day. Time to make some donuts. I don't know, donuts usually mean zero, man. I don't know if donuts is what I'd be going for. We're looking for at least breadsticks here. But yeah, good morning, everyone. If you're new to the stream, my name's Sean. I'm the co-founder of Predicting Alpha, and every single day, Monday to Friday, we gather here live to break down some trades together, take a look at what's going on in the market. I have a few trades that I'm going to go over today with you. But before we get started, if you find this live valuable, please make sure that you have subscribed to our channel. It makes it worth it for us to keep doing this for you guys. It lets me know that you're finding this content valuable. And it just, overall supports us trying to bring data-driven trading to everyone. So today, first thing we're going to do, let's take a look at what's moving in the market at a macro level. Right, SPY vol increasing a little bit, TLT, NASDAQ, USO declining in volatility by a few points each, but we're seeing a huge spike in SPY vol actually, which is very interesting. Yeah, hit that thumbs up button, right, Eric? Eric, that means you better have hit it. I'm counting on you here, man. The YouTube algo gods have not been too kind to the Predicting Alpha family, and it's time for us to fight back. So, as you can see, vol's all over the place. A lot of things are seeing positive movements. We have a green day in the market so far today. Vol's all over the place. Points moving up and down across the board. SPY vol increasing by 4.89% so far today, which is a pretty big move. So let's take a look at some of the news that was coming out. Right, I came into the terminal, just quickly took a look at the global news section, and I saw a couple things that you might want to be aware of. Number one, FDA staff recommending to watch for Bell's palsy in Moderna and Pfizer vaccine recipients. The major headlines are 4 cases of Bell's palsy reported among 30,000 trial patients, including 3 who got the vaccine. However, the current information, we don't have enough to determine if this is actually a causal relationship or just happened by chance. But something to keep an eye on. If it did come out that, let's say, the Pfizer vaccine was, correlated with getting Bell's palsy, well, we might run into some trouble there when it comes to distribution. People with certain underlying conditions maybe wouldn't be eligible to take it, and that could cause some more volatility around the stock, especially since it's been all positive news recently. If this gains much more traction or comes to fruition, could be really bad for the companies. Now, I also found this one to be very interesting. Maybe for any long-term plays you're looking at, this could be worth chatting about. It says that 1 in 4 Americans will be working remotely in 2021, as revealed in an Upwork survey. Right, so this sort of leans to what a lot of people have been thinking recently, which is that work from home is becoming more popular. Right, this situation, not only did it force a lot of people to work from home, but it forced a lot of companies to set up the infrastructure to allow their teams to work from home. And, I was talking to a few business owners recently, and they're saying this is actually working pretty well, right? For a lot of professional services, right? Legal, accounting, and any fields like that, it seems to be making a lot of sense for them to work from home. Sales are having a good time working from home, software development. And now that we've built that infrastructure, there's actually a good chance that this might become more of the norm than what we've seen in the last decade, right? It sort of just amplified how quickly we're going to be making this move here. So these are a couple interesting articles that I came across this morning. But beyond that, let's talk about some trading. Now that we have a little bit of an idea of some of the things happening at a more macro level. First thing I want to talk about is a follow-up on the trade that I entered yesterday on ARK. So yesterday at around 10:30 a.m., I entered the position before I actually came on the stream. But yesterday, 10:30 a.m., first thing we talked about was ARK. ARK is basically a really easy way to think about it. It's got all the hype stocks in it, right? All the growth tech stocks. So it's got CRM in there. Its biggest holding is Tesla. And we were looking at this yesterday, and the implied vol was at 57. So let's take a look at how the IV-RV has moved together. Let's zoom in. So we pretty much chatted about this up here when vol was at 54. And on the stream, right, literally 20 minutes after, right, I'm wondering if maybe we had enough volume in this chat to move the market or something, because on the stream, vol got crushed by 6 or 7 points. I opened up my brokerage and I was up $500 per lot. Absolutely crazy, right? We had structured our trade. That's why I have the IV90 on here. We were trading the further dated options, and that drop in IV drove a huge P&L for us, even though the stock didn't move. And these are the things when we're trading options that we want to be thinking about. I always stress the importance of knowing what your option is implying. What is baked into the price of this option? How does it change as market conditions change, as views on the company change, future volatility forecasts? And in this case, we made a ton of money as the market started to realize that it was pretty irrational to have this level of volatility baked into an ETF. Right? Obviously, with Tesla being the big holding, our view was that the S&P inclusion would be the catalyst that vol would start dropping off. However, it started dropping off much earlier than we anticipated, which worked out in our favor. But we are still in the position because vol has not come all the way down to what our fair value assumed it should. So we are still in this position, even though we are up right now. And if there's one lesson you can take from this live off the bat, if you're a new trader here or even a veteran trader, it's don't cut your winners short, right? Have your idea of what fair value is. And if the position starts moving in your favor, it doesn't mean to take it off until you've reached that fair value, right? Until either you're wrong or your fair value is reached. If there's still juice in the trade, you keep the trade on. Live on credit. Don't pull profits just yet, because there's money that can still be made in that position. So we're still in it. Falls down at 45.94 at the 30 days, and you can just see, if we go to the vol cone here, when we were looking at the trade yesterday, this was all the way up here, which was absolutely crazy. And so far, so good with this trade. So Neil, we will be managing our deltas as we need to. I currently have not had to manage the position. We were leaning a little short deltas at inception, so we're actually like right in our body right now. Like things are looking very good for the position. So next up, wanted to talk about a couple of opportunities that you could put on for pretty cheap with pretty good risk to reward trades. The number one trade that I'm going to be looking at is NEO. So let's pull up what's happening with NEO right now. Obviously, this is an extremely popular stock, right? So let's have a look here. So first thing I'm seeing with NEO, IV, pretty high compared to the forecast, but forecast is really high too. We actually are in agreement that this thing is going to move a lot, right? Market thinks this thing's going to move like crazy. We think it's going to move like crazy. Market thinks it's going to move a little more with a little more volatility than we do, but I actually don't see that as being the trade to take right now. What I actually see as being the trade to take is something to do with this skew right here. So if you remember on the last few lives, guys, we have been talking about 1-3-2 flies, right? Taking advantage of these expensive out of the money calls, or if it was the other way around, the expensive out of the money puts to structure a directional bet, right? So if you're bullish on NEO, but you don't necessarily think this thing's going to jump 100%, well, there's a trade we can put on that can, I just priced it out. You probably get around 5-to-1 risk reward, only having to put up $1 per lot. And I think this is a trade, if you're bullish here, that might be worth putting on. So let's take a look at how I would go about structuring this trade. I actually have it opened here, but we'll go structure it together just for fun and for learning's sake, so you can see exactly what I'm doing. The 1-3-2 fly takes advantage of expensive out-of-the-money calls while still giving you a defined risk trade. And because we're taking advantage and selling those expensive out-of-the-money calls, we end up getting a pretty good risk to reward trade on our hands. If we find stocks that have a ton of skew, we can get even 20-to-1 risk reward. But when we're looking at this one, it's going to be around 5-to-1, 6-to-1 risk reward. Let's go to the 24th weeklies here. and structure out this 132 fly. So I start my 132s at the money, and the first thing I need to do is actually just price out what the straddle is going for, because I'll be using that to structure out my trade. So the straddle is going for, let's call it about $5. But issue I'd run into was that I'm going to have some issues with strikes on that. So what I'm actually going to do is structure the width of them $6 apart. So let's assume that was 6. Here's what we'll do. I'm going to come to the current strike, at the money strike of $44, go to the call side, buy an unbalanced butterfly. And you can see off the bat, it structures it in a 1-3-2 format where, it's currently 10 lots, but, we're buying 10, selling 30, and buying 20 further out. What we need to do now is actually pick what our strikes should be. So what I already know is I want my low strike to be at $44, right? So I'm going to buy 10 at 44. And now I'm going to use that $6 that I calculated from looking at the straddle price to place my sells. So I'm going to move up another $6. So I'm going to put this at 50. And then for my hedge, right, this far one, this is really to hedge and give us that defined risk. I'm going to put that at 53. So let's take a look at this trade right now. Not bad. Max risk on the position is $920 more or less. And our max return is about $5,000, right? So as you can see, we're getting about 5.5 to 1, 6 to 1 risk reward on this trade. And what needs to happen for us to be profitable is the stock, which is currently at $44, needs to rally up from 44 and as high as 53. Remember, with these positions, sure, we give up that potential for the absolute blowout, but if we believe the stock is just going to trend in an upwards direction, this is a trade we can put on, take advantage of the skew, and give ourselves that high risk to reward. So let's say, here, I'll break it down one step further. Slow me down if I'm going too quick with this. Let's say we think the stock is going to go to $50, okay? If we put on this trade, we risk 1,000 to potentially make 5,000, right? If our view is correct, and by December 24th, NEO is sitting around $50. Well, why would we do this over trading a call? So let's come back here and take a look. If we just go here and buy a call, let's see what our P&L looks like. So in this situation, we would be risking, let's say we put a similar level of risk on, right? So this is 28 right now. So let's go down to maybe 4 lots, maybe 3 lots. Okay, yeah, so somewhere between 4 and 3 lots. But we are risking about $850. And if the stock moved up to our strike of $50, we'd only be making $1,000. You see that? With this position here, if we just buy the calls, same level of risk, we only make $1,000 if our view that the stock goes to 50 is correct. But if we structure this 132 fly, we make 5,000 for the same view. And this is the importance of fitting the structure you use, using the right tool to express the view that you have. Does that make sense? The big mistake a lot of people make is they have a certain view, but they use the wrong tool for the job, and then they either don't capitalize on what they could have, or they end up getting burned, right? And that's the beauty of knowing your product in the option space. So if you don't have any questions about NEO, we are going to move on here to look at a few earnings trades that were on my radar for today. There are really three earnings trades that we'll take a look at. We have one that we really have our eye on for tomorrow after hours. So tomorrow's live, make sure to check it out if you want to talk about what's going on with the FedEx earnings. But we'll save that for tomorrow. We still have some time before that. Today, we're going to be focused on GIS, ACN, and LEN. So let's hop into it and take a look. So, by the way, if you have any trades that you want me to break down with you, feel free to drop them in the comment box. It's awfully quiet in there right now. It'd be good to get some chat going, see what you're looking at. More than happy to break it down with you. So, First up, let's go to our earnings analyzer tab and let's take a look at GIS. Okay, let me just confirm here. GIS earnings, yeah, just because, yeah, perfect. Okay, before market open. Great. Okay. So what we see off the bat, GIS has a implied move of 3.51%, meaning that the move the market is expecting for GIS going into their earnings is about 3.5% up or down. When we look historically at the last 4 years of earnings, we see that they have an average move. So what actually happens is an average move of 1.89%. So significantly lower than what the implied move is. We see that they have an average move of about, an average implied move. So if we look at what the market thought would happen at each of the events, on average, they thought it would move 3.6. So their estimate is a little bit more conservative than what we typically see for this stock, but not by anything really significant here. So let's take a look a little bit deeper, see what we can do here. We can see here that the straddle price typically does not have a huge change after the events, right? Very, very minuscule change. And this leads me to actually think that it might be worth taking a long vol position here. Because if we do end up being on the wrong side, what we see is that the straddle price typically does not change drastically from pre-event to post-event, allowing us to get a cheap ride on a long vol play here. If we do happen to get an absolute blowout move, we're going to make a ton of money. And if we don't get that move, we get a smaller move than what the market's implying, it's not going to cost us a ton to actually take on that risk. So I would maybe be looking to take a long vol play here, right? Implied move is not crazy high. We could see a move like that pretty easily, right? Like there's times where it moves 7%, right? You could be making 100% on this trade if you do get a big move like that. And you can put on that trade for pretty low risk, seeing as when we do get small moves, it's not like the straddle price changes too much pre or post event. Looking at the straddle P&L, we can actually see that it's positive, which, not hugely, very minutely positive. You would have, after the last 4 years of earnings, you would have only come out with a 5% profit. Nothing to really get excited about here, except for the fact that it's actually not negative, right? A lot of the times when we're looking at these earnings trades, we're going to see a negative straddle P&L, because if it was, profitable to simply just be buying an option around earnings for a company, who would be out there selling them? But that gives me a little bit more confidence that taking a long vol play here might not be the worst idea in the world. And we see about a similar P&L for the calls and puts. So that would be one that I would have on my radar as a long volatility play. If I were to be structuring out a trade for it, I would just do something like this. Go to GIS, trade. Maybe, we need to make sure there's some liquidity here, but okay, this actually looks okay. Let's see here. Actually, there is a bit of a spread here. It might be a little illiquid for my liking, but if you're, hell-bent on taking a trade here, you could just pick up a straddle, $60 straddle here, and let's see what it looks like. So, right, we are right now on the 16th. If we get that move, right, one day move is going to be big. If the stock moves outside of our break evens, which are about 58 and 61, we'll be making some good money. And if it stays within it, we have a maximum risk of probably about $500. And that's for putting on 10 of these lots. It's going to cost us $2 per lot to put on, and we are risking about 50 cents of that, assuming we close out right after the earnings. The big thing, though, to keep in mind with this trade is you want to be putting on these earnings trades. At market close, right? You don't want to be taking on the market and not event volatility from during the day. Put on these trades as close to 4 p.m. as you can. Maximize your exposure to the event get out when you see event volatility start to drop off, or if we, get the move that we expect. So let's take a look at a couple more earnings trades that we have here. We have ACN coming up. ACN's looking like, we have a similar implied move to GIS. This is looking at about 3.75% implied move for the event that is happening before market open tomorrow. But we have an average move of just 1.32, right? ACN is one of those companies, it doesn't really move much around earnings, right? The biggest move we've seen, we saw a 5% move, back in basically COVID times. But since then, the implied moves have been, the actual moves have been pretty small. Looking historically, there's really only 2 times in the last 4 years where you would have been on the wrong side of the trade if you were selling vol here. So I would definitely be looking to short vol around ACN earnings. You would structure that trade as probably an iron condor. But first, let's take a look at the skew. Make sure that we're not overpaying for those wings. And we actually should be okay here. Yeah, we should be okay. Let's go take a look at ACN here. Let's head over to trade. If we were to put on an iron condor, what would that maybe look like? All right, so we'll trade the short dated December 18th. Let's price out the straddle to start. All right, stock's trading at 247. And the straddle's going for about, we'll call it $10. So what I'm going to do now is put together an iron condor that I want to be trading. 247.5, sure. Okay, let's see if we can get the strikes for this. We're going to sell an iron condor, and we're going to put our wings at 2 times the straddle price on either side. That's going to be the width of our strikes. So we're selling here, and I'm going to change it to 247 so that we have the at the money straddle that we're selling. And now we're going to go structure out our wings $20 above that. So at 267.5 for the call and at 227.5 for the put. Okay, it looks like we're able to get this on. Let's analyze this trade. So we have a pretty good trade on our hands here. If the stock stays between 239 and 256, we are going to be making some money there. And if we see a drop to, if we see a pretty sizable move, our max risk is about 11 grand for a payoff of about 9 grand. So if it stays within this range, we're good. One thing I would do is really see what you're comfortable with. If you think that these wings are eating up too much of your edge, you can actually go just sell the straddle, right? Obviously, you're taking on more risk when you put on a trade like that, but you get to keep more of your premium, meaning that you can take a bigger hit and still be profitable, right? Your width, your break-even width is wider if you're just selling the straddle. So let's take a look at that. Right now we go and we have a break-even at 238 and at 256, right? So you can see that the width that we have for a break-even range is larger when we don't pick up those wings, right? Think about it. Now we're collecting $9.35 instead of, $8.35. We were paying out $1 for those wings. Pretty pricey. But obviously now you have that unlimited risk exposure. So one way you could handle this, right? If you're trading, a pretty good sized account, is instead you could scale down your position. Stress it to a three standard deviation move. What's your max risk there? Maybe try to structure it so that your max risk at a 3 standard deviation move is similar to what you would see if you had your max risk on for iron condors, and you just have to scale back your position if you want to do that. So we have one more earnings trade that we want to take a look at today, which is LEN, which is already took a look at it this morning. It's looking like a pretty good short vol opportunity. Let's take a look here, right? So we have an implied move here of 5.96%, basically a 6% implied move, which is much higher than what the market usually implies going into this event. And it's about 3 times as high as the average move that we see for LEN. Taking a look at the straddle P&L, we can see that the cumulative P&L is negative 68%, trading straddles or buying straddles around earnings, meaning that selling straddles has been historically very profitable for LEN. Taking a look at the calls, negative, put's going to be just about break even. Taking a look at the implied moves, we see that this thing has more or less been, historically at least, systematically overpriced. Let's take a look at the straddle change in price. We can see that the straddle tends to get crushed after the earnings. So this is looking like a pretty good one to be short volatility around. Once again, similar reasoning. Looks like it's historically systematically overpriced here. I think that the odds of us getting a huge blowout move probably not as high as some people might think. But and we can get that by looking at what the moves have been historically, right? Average move is just 2%, right? 9 times out of 10 we get this tiny move. But in recent days, move has been a bit bigger, but the implied move has been even bigger than those. So we can say that there's probably a good chance that shorting vol here is a solid trade. One thing you could be doing as well is take the 3 earnings trades that we've talked about here, right? GIS, ACN, and LEN. Trade small in all of them and spread your risk across a lot of these trades. Something to always remember when we're looking at earnings trades, when we're using this statistical approach to build a strategy around it, we have a very small edge, right? But this edge is still significant enough that we can make a lot of money doing it. But similar to how a casino doesn't just have one roulette table, you don't want to have just one trade on when you have just a small but well-defined edge. You want to be spreading that risk across multiple trades. So you could be taking ACN, GIS, and LEN, spreading that risk, and hopefully having a better shot at realizing your expected value for trading with this small edge. So moving on, let's take a look, do a quick scan of what's going on, anything else that's moving big today. And besides that, if you have any trades that you want me to take a look at for you, we're going to move into a session where I just take ideas from you and break them down live, talk to you about them, help you structure out trades. So let me know what you guys are looking at this morning and we can hop right into it. Putting in a price filter, just going to do a quick scan, see if there's anything that catches my eye that we can continue this conversation about, but need some feedback from you, need to know what you're looking at this morning to keep the live entertaining and engaging. Let's see here. I'm just scanning for stocks that have a high implied volatility relative to what we're forecasting the volatility to be in the future. So STZ, Constellation Brands, I'm seeing popping up here. Let's see what's going on. Right, implied vol is pretty big compared to forecast. Taking a look at the volatility cone, we can actually see that near dated vol is it's actually below median and it's above it a few days out here, 30 days out. Wouldn't be surprised to see if we have an earnings event. We can see that little spike here in implied vols. You're saying CCL most likely has earnings on 12/18 before market open. They don't give notice. Really, they historically don't give notice on their earnings? That's extremely strange. I was not aware of that. Justin, do you want to share a little bit more detail about what you mean? Eric, I'd be happy to take a look at that as well. Right, implied move of 5.8, average move 1.8. So, Eric, I want to, or Justin, let's take a look at this quick, right? So if we look here at 2020-03-20, so right in the middle of COVID, right? If we look at these two right here in COVID, all of the earnings since COVID, right? We have an implied move in March of 18%. And we have a jump of 6. Let's look at the next earnings. Implied move, 16%. The move was 5. Implied move, 13.8%. The move was 0, basically. So what we can take from this is we always need to remember that the market is forward-looking as well. We're looking at the landscape for them right now and saying it's different. But what's the market saying? The market knows that they're not out there cruising. They know that the staff are furloughed or laid off. They know that there's no revenue. They know that the ships still need maintenance. What do we expect them to come out and say this time? That could be a surprise. One thing that could happen is the guidance for the future could change. So if I'm correct in this, CCL has come out and said that they expect to be, up and running next year. I believe that's been the vibe for the last few quarters. So if they were to come out and say, we're actually not, and this rough period for our revenue is going to continue beyond 2021, well, that would be something that could cause a big upset in the stock. But besides that, it sort of makes sense why there hasn't been much of a move. We've sort of known what the information would be prior to the event. So, I would probably still be comfortably shorting volatility here. I don't think we'll see any major moves. Especially in recent times, it's been pretty good to sell vol here, right? Puts have been extremely profitable. Calls probably not so much. But let's take one more look at this. Yeah, you can just see the straddle price just gets crushed. So I wouldn't be I would be maybe looking at a short vol trade for this. If you don't know the exact confirmed earnings date, that could be tricky. I'm seeing the earnings event to be forecasted for the 18th before market open as well. So as we approach that event, if we see this implied move creeping higher, I'll be pretty inclined to be selling it. Eric, what are you looking at? VIAC. Any information about that company I should be aware of, man? Okay, it looks like they have earnings coming up as well. Not a ton of data around it, though. Pretty new company. Let's take a look at what's going on here. Okay, implied move 40. Eric, what's the trade that you're looking at here? I'm not seeing too much sauce right now. One thing that I am seeing, though, is it looks like implied volatility is pretty low. Right? Looks to me like the current implied volatility for the short-dated options are below, across the board actually, below the third quantile. Okay, nice. The RV came way up in the terminal today, eh? Okay. So yeah, you know what? This actually looks like an opportunity to buy some volatility. You could do it in a couple of different ways here. If you want to be trading the earnings event more, you could be trading the short-dated options, get more gamma exposure, right? So if you get that big move or a quick move in the near time period, you'll make a ton of money doing that. But if you want to bet on the level of implied volatility, mean reverting, we could be buying some further dated options, maybe the 60 or 90 days, hoping for it to come up maybe, 7 or 8 points here. Could be looking pretty good. Eric, how do you have your trade structured? Let's see here. If we go to the relative value, we type in VIAC. Let's take a look at it. And let's compare the IV with the RV. Let's see how we're looking here. Okay. So I'm actually, let's go with the longer dated IV here, see if we see anything different. Right, so we can see that the ratio is pretty high here. We could see it come down a bit, right? But If I were to be taking a trade here, I'd probably be structuring out something a little long vol. Vol's looking a little bit cheap, especially in the back months. If you have a view on the earnings, well, then I would be going shorter dated to get more exposure to it. But seeing as I have zero view on it, I'd be looking, at the back months. Eric has a single call on it. Well, man, looks like, depending on where you bought it, that call might be printing. Actually, no, it's probably not printing, but hopefully it is in the future, man. Okay, so if we have no more trades that you want me to break down with you, we're gonna wrap up the stream there. Hope you guys enjoyed a quick look at the terminal here, breaking down some trades this morning. Oh, earnings not till Feb. Oh, shoot, I thought they said 12. It says 02. Yeah, I thought it was December 18th. My apologies. So yeah, then I'd definitely be looking to structure out, buy some volatility long dated on this, man. I think it makes a lot of sense to be doing that. But yeah, guys, this has been a pretty fun stream. We went over the ARC trade, took a look at NEO. ATVI is also a good one for a 132, by the way. Took a look at some earnings trades and what's going on in the market. No problem, guys. I hope you enjoyed that. Remember, Predicting Alpha is the only place that offers this level of data for this cheap of a price, right? $79 a month. A terminal like this can be yours, along with every piece of education and support you could need to make it actually worth your while. So if you want to come trade with a really good group of people, a professional grade group of traders with professional grade education and tools, take a look at Predicting Alpha. Visit our website. It's just predictingalpha.com. And if you enjoy coming to the stream, just chatting with me, please drop a like, drop a subscribe. It helps me at least figure out which lives were valuable, why they were valuable, so I can keep making more videos like that for you and being here every day. So take it easy, everyone, and we'll see you tomorrow.